I want to start with really the debate that we've been having on the show this morning, which is the Fed behind the curve or ahead of the curve if they cut rates in September?
Well, good morning. That is a great question, and I think the Fed is in an okay place right now. I think that they have spent a lot of their time indicating that they need confidence that inflation is going to be on a sustainable path to get to 2% inflation. And I think that's a stiff performance bar. I think back in January, they were nervous that so many people thought that many rate cuts were ahead, and then the inflation path in the first quarter was bumpy. But they appear to be much better. The last press conference, Jay Powell indicated that inflation progress was welcome. And, everybody's expecting a better number this morning. So I think they're in a position where they can respond to the improving inflation data and, the normalization in the labor market and a bit of nervousness with the fact that unemployment has gone up. But I think it's time for them to, really start talking more about how they're going to act and actually act.
Charles, you have the luxury right now of not actually having to represent the Federal Reserve, and you can talk about what your impression is of market positioning. So let's go there. The fact that the market has pretty much full confidence that the Fed is going to cut at least 3 times, probably 4 times this year, 100 basis points of rate cuts. We were speaking earlier with Justin Cole, who basically was saying, why? There is no sign that they should be cutting rates given the fact that the economy still is strong and the labor market hasn't turned over. What's the argument to go now, given that we're not seeing a negative print on jobless and on jobs creations?
Well, the funds rate's at a restrictive rate of 5.3%. They set that in July of last year, and inflation has come down. So by its real measure, it's only gotten tighter since they took those actions. Inflation has come down. If you look at a bunch of benchmark policy rules that the Fed looks at, they don't follow them necessarily. I mean, they certainly don't follow them in lockstep, but they're a guide as to where policy likely would be headed. And they are far south of where we are right now. I think I saw something where John Taylor said that his rule says that the Fed should be at about 4%. That's quite a long ways. Jay Powell has said that the labor market is normalizing, and they seem to have more confidence that the labor market is only normalizing and not doing worse than that. Even though the unemployment rate has gone up, it's 4.3%. Now, maybe the most recent increase was for some positive factors like increases in labor force, but it has increased by, substantially. And the unemployment rate usually it either goes up or it goes down. And when it's going up, it usually keeps going up. And so it would be, quite sensible from a risk management standpoint to sort of take an initial action and step down somewhat from the restrictive level of 5.3%.